Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Wednesday, November 8th, 2023. It is 10:16 a.m. as I'm starting this video, so we're about 45 minutes into the trading day. And what I'm going to do here is go over a couple different trading strategies I want to share with you, and then take a look at some of the things that I haven't covered in a while. So it'll be a little bit of a refresh. Now, I'm still going to talk about the equity markets in this one. Like I said, there's not a lot of individual or trade ideas that I'm crazy about. Not a whole lot of anything right now. There are a couple things out there. I still like that Bitcoin trade, the orange juice trade, the commodities, natural gas, crude, precious metals. Kind of just standing back from those now. But let me dive into the charts here, and I'll take a quick look at this, and I'll share my thoughts, and then a couple trading strategies that you might consider right now. This is QQQ. This is the daily chart on QQQ. You can see here. Let me turn off all the lines real quick, and so let me try to draw up another board here. Let me take this away, and so I can go like this right here. We have the uptrend line. If I capture the very, very tippy top of that candle, my uptrend line comes in a little bit higher right there. See what I did there is zoom in real tight, come in real close to the top of that candle instead. I had cut it before. That was my preferred trend line. Why? Because it has more reactions. You see one there, one there, one there, and the initial one there. And so by that account, we're above the trend line right now, like I mentioned the other day, with some price resistance just overhead that we ran into. But let me show you a few other things. And this is to me very, very important. I'll cover QQQ most often. I like to trade QQQ typically over SPY or the mid caps, small caps, the S&P 500. However, it is far from the stock market. It is the least representative index, representative of the economy or the stock market out there. Again, it's turbocharged with a lot of tech. That's what it is. It just has an abnormally high weightings in the top, Magnificent Seven stocks. The same, top holdings in the NASDAQ 100. But let me just show you. I'm sorry, S&P 500. But let me show you a few other indexes, of course, again, because this is what we want to look at. Here's SPY. SPY is still well below the primary downtrend line right there off the highs. You can see it's coming up to it, plus it's at resistance zone. Again, no change in the last couple of days, and it's where we were. We had this sharp rally up there and kind of stalled out. And so SPY is still, just a hair below that previous reaction high from was that October 17th and under the downtrend line. And then there's another one. I don't cover this often, but I have it in a watch list. I have a watch list of all the big indexes and the key sectors out there. And it is VTI. A couple of years ago, I came across this. I don't know, I'm reading on something, and it is the Vanguard Total Stock Market ETF. So as I often talk about, SPY or the S&P 500 is much more diversified and more representative of the overall U.S. economy because it has 11 sectors. It includes financials, which are a very important part of the economy, especially right now with these high rates. That's where I'm looking for any kind of red flags or warning signs, and that the NASDAQ 100 lacks financials. So again, the NASDAQ 100 is not really a good index to kind of get an overall gauge on the health of the stock market. Now, think about the S&P 500 as diversified as it is with 500 companies spanning 11 sectors. It's still only mega caps. They're the very largest of the 500 largest stocks in the U.S. And so, we can look also collectively at the mid caps and the small caps, or we can look at this one. This is the Vanguard Total Stock Market ETF. Here's just a little about it. This is from Vanguard's site. Basically, it tracks the entire U.S. stock market. So it's not a global; it's domestic, as it says right here. So it has it all. It tracks pretty much the entire U.S. stock market, large, mid, and small caps. So if you want just one single ETF, whether you want to trade it or kind of track it, then that's the one to look at. And this one also, just like the S&P 500, is coming up, but still below its downtrend line off the highs. Still just a hair below that previous high. So it is also in like the S&P 500 in a downtrend, kind of pushing the upper limits, but as I like to say, resistance is resistance until unless broken, and a trend is a trend unless the evidence presents otherwise. So really, if it breaks out there, there's a whole confluence of key levels. So you have not only the downtrend line off those key mid-July highs, major reaction high. I had an uptrend here. I'm not super crazy about it because we went through it a few times. Maybe take it and go like this. Yeah, that's how I would tighten it up a little bit. And that's the trend line off the lows. There's another reaction there. Then you broke and back tested it. So you're still below it. So pretty much if it does this, you've taken back the primary uptrend line, which we're now below. You've negated this downtrend here. And you've also taken out that downtrend line off the highs. So where am I going with this? All right, so the other day, I've had a couple areas where I thought the rally might stop and turn, and it just went on through there. But this was, at least for QQQ, and again, I just showed you the other indexes. So my max bounce target was the downtrend lines from back here. Remember, reverse long here. Fortunately, I didn't stay long that whole time. No big deal. Nobody bats 1,000. However, the most important thing is, where do we go from here? What do I do now? So one of two things. So I made the case recently. Now we have, for the first time in a while, what I really like to see on the 60-minute time frame, we have overbought conditions with negative divergence. So I put the probability on a red close today as very high. High would be, favorable. Here's how when I speak, my terminology is if the odds are favorable for something, that just means above 50%. If they're high, I'm not going to, if I had to quantify it, high is probably 70, 80%, and then very high is probably 80, 90 plus. So I think there's a very good chance we close red today and we get that pullback. And I've given you some targets recently. They're on this board right here. 1, 2, 3 pullback targets and an uptrend line. Now, if you recall, a couple weeks back in here, I can't remember if it was exactly where, but I had mentioned this. I said, positioning for covering shorts, reversing long, expecting a rally, and stating that this rally will probably, if it's, I held these analogies about a bear market, how a bear market has to convince the masses that we're not in a bear market, especially a bear market rally. If we're in the stage of the bear market I talked about recently, I showed you that chart, stages of a bear market, showed you that return to normal kind of rally. And what I said is typically you want to see the rally reach the point at which the vast majority of market participants are convinced that the worst is over, that we're going to new highs. In other words, I said just as the rally really starts to look like it's the real deal is probably when it's going to end. Well, like I said recently, I can't make a strong bearish case at all, fundamentally and technically, because of my bullish outlook on Treasury bonds. However, just because I have that bullish outlook, and I can see a much bigger drop in yields, which means a rally in bonds, which would be net bullish for the stock market. Again, little quotes around the word net bullish. Falling rates again are a net bullish factor for equities and the market, but that doesn't guarantee that it's going to raise stock prices. Okay, Randy, you just said that's net bullish. Net bullish just means in itself it's bullish. Meaning, another way to look at it, stocks could be falling for whatever reason. Again, I've talked about 101 things where I'm looking to see where the next cracks are going to come from, whether it's the regional banks, the big banks, the non-bank financials, big hedge fund blow up, you name it, pension fund problems, anything else. And so whether the drop in the stock market, forget about treasuries for a minute, comes soon or it comes after, months from now, maybe sometime next year before we get a big drop. When that happens, stocks could be going down. And so if interest rates are falling, that should at least help, and maybe stocks would fall less. So that's still a possibility. So again, net bullish doesn't necessarily mean stocks must go up. You could see yields falling, as I've talked about, because of a stock market sell-off and a flight to safety into institutions. Also, realization that a recession is now imminent or upon us, at which point stocks will likely be falling, and so would interest rates, yields, and therefore treasury bonds will be rallying. So there are those situations there. And however, while falling yields should be net bullish for equities, obviously rising yields, should yields continue to rise, and this is what I wanted to talk about. This is still the primary uptrend line for TNX. This is a very important trend line. And although based on these divergences, in fact, we're there, it looks like this wedge is ripe for a breakdown. I say that because when you look at the divergence line in this uptrend line, this is the part where wedges usually break down. They don't go all the way into the apex and then break down. So if it's going to, it would want to do it here. However, there is no guarantee. And as I like to say often, as I do often say, support is support until unless broken. So we could see all of a sudden this reversal here. You have some nice price support as well. Right here, you can see a couple candles around there. Key reaction low right there, the big bullish green candle. And we've been dancing on that. That's 45.26 on TNX. And I'm sorry if I didn't state it, you can see it down here. That's the 10-year Treasury yield. And so that means 4.526% is what the 10-year is paying. And so this is certainly a possibility. Maybe this trend line breaks. Maybe these divergences do play out for a nice reversal, but maybe it happens later. And so I'm going to talk now about trading strategies right now. So taking that, what I just said, that there are no guarantees that yields are going to continue to fall. One thing I will say, that is the vast consensus. I underestimated just how, how do I say this? The reason, technically the reason I went long before pre-Fed and all that was for all the technical reasons I showed you. The stock market, many of the key stocks falling to their 200-day moving averages, the NASDAQ 100 itself falling to its 200 days. And I said, this is the first time, I talked about how much we had fallen and how I would be surprised, not completely shocked, but surprised to see the market go right on down through the 200s like they're not there. I've been doing this long enough that a big drop down to the 200s, especially if you mix in some bullish technicals, which we most certainly had. We had all those big market leading stocks hold, fall to support, my key purple support lines, Apple, positive divergence. So again, I don't want to go back to what I was doing through 2 or 3 weeks ago, but there was 101 reasons to go long recently. Now, the $1 million question is, do you stay long? And so where I'm going with this is you have two options. I'm going to share them with you, or at least I look at it this way. Option one, I think even the most ardent bull right now agrees that, this is a little bit hot, that many green candles, you don't really see that many, one of the biggest pops in a while, and that at the very least we need a little consolidation or a pullback. So again, I think it's we can all agree, even if you're bullish, maybe a pullback to test the downtrend line on QQQ, or maybe any or all of my targets. So here it is, option one, short here. I really think the upside is very limited at this point. One of the best, shorting ops I've seen in a while right now. Divergence, overbought conditions, at resistance, which I just showed you on not just QQQ but other things. And so you go for the quick pullback trade. I've given multiple targets. The minimum target would be a back test of the trend line. If and when that happens, you got to, remember it's going to go forward in time, so you got to slope the line down. So it's going to be about 1.25%, maybe, give or take. Or you go all the way back here to my current max near-term pullback target, which is about 361.60, and the uptrend line, that's about a 3, again, depending if and when we get there, a little bit better than a 3% drop. Okay. Now, that would be a near-term trading plan would be to cover short and reverse to go long, especially if you believe that we're going to go on and take out that high and continue to run up in the market. So that's option one. Or even just taking profits there on the short trade. But let's just talk about the short trade part of it for now. Okay, you can reverse, and that's up to you. So option one is you get down towards there, take your profits and get out, or set a very tight stop. And that way, if it does reverse, you're going to get stopped out. However, it gives you the potential, and this is where you can either have a tight stop if you get down towards this level in this trend line, or a little wider stop. Now, a wider stop, in other words, short here and give it some room. If you have a wide stop, you're not going to get shaken out on the counter trend bounces. So your initial stop, for example, might be above the next resistance level over there. Then if and as this thing starts to play out, at some point, if you get down here, let's say we make it about to this point right here, yeah, you can then lower your stop maybe to right here, or break even at least, so you don't lose any money in case we reverse. And then a little bit wider stop helps you not get shaken out on the counter trend moves. And then where I'm going with this is you can, shoot for the moon and stars. That whole, if the market's going to go down and take out the recent lows, this low, the 200 days, and head a lot lower. Remember, these are still just intermediate term targets that I have. Longer term, I roll back over to the daily chart. The weekly charts, and that's where my longer term targets are. So I'm still leaning that way, that we are going to head into recession, that it's inevitable and imminent at this point, due to many factors. Let's not digress, but including largely, but not limited to, the surge in interest rates in the lag effect there, which hasn't fully kicked in. And so there's a lot of downsides. So I look at everything, all my trades, I like to frame it in this aspect. And it's, in trading and trying to develop your trading plan, whether you're going to go for the big swing here and then give yourself some wider stops, or you just want to focus on hitting a bunch of singles and doubles instead of trying to hit that home run or grand slam. So what happens is the RR on this is better. If you're just going for a quick pullback trade, 1 to 3%, the probability of that short trade playing out is much higher. However, the reward isn't as good. So I'm going to use the analogy. It's just like going into Vegas, right? You step into a casino, you walk up to the roulette wheel. Well, you can put your money, your chips on red, black, even or odd. That's the best odds in that game. You have about, I think it's like 46%. It would be 50-50 if they didn't put the two green, the 0 and 00 in there. That's what gives the house an advantage by doing that. And so, but you have a much higher, almost a 50-50 chance of winning, right? But the payout's going to be 1-to-1. You risk $1, make $1. Now you can also just pick a number, like put it on 18 or put it on any a 0 or a 00. You're going to, the chance of you making money on that roll is going to be a whole lot lower, but the payout's going to be a whole lot bigger. So that's how I would look at this. If you want to take that, short right now, while everything looks hunky-dory, price action's been good, interest rates, by all accounts, the vast consensus out there, the Fed funds futures, everybody's betting the Fed is done. The $1 million question is, what's going to be, what's the market going to say about that? Remember, the Fed does not set the rates on the 10-year Treasury bond or the 30-year. The market forces set that, and so we'll see. We'll see where interest rates go. I just wanted to talk about that trading style. Trade those two trading plans. Either kind of keep your stops tighter, where you're not risking a lot, and try to swing any or all. That's that target zone right here. I'm gonna box it in one more time. Again, I've laid out these targets the last couple of days, anywhere from here to there. That's my pullback target zone. Or shoot for the big one. And doing that again, if you run a tight stop and you're trying to swing a home run, for a double-digit trade, I see, you ask me, I see another 50% downside in this market. We'll use that VTI for a second here, where I think we're ultimately going. This is just a daily chart, And let me just analyze this real quick, and then I'll show you the weekly. So you have the primary downtrend line. Again, this is the best measure of the entire U.S. stock market right here. It is in a downtrend, make no mistake about it. Put in a big divergent high here. That was what I believe to be the initial leg down in a new bear market with more to come. This being a counter trend rally right here, bear market rally, which ended with a divergent high also right here, negative divergence. Let me draw it for you. Divergence, little wedge, breakdown, secondary trend line taken out right here, back tested, rejected. We're still in a downtrend. The primary uptrend line taken out, and so that's what it looks like on the daily chart. PPO is in bearish territory. What I look at is the 9 EMA, which is the white line, the signal line. That's the last of the two to cross. Typically, when the signal line is above the zero line, as it was there, your trend is bullish and you want to be long and strong. And when it's below, as it was here to here, and during this period, you can see the trend was down and bearish, and you wanted to be short and selling the rips and bounce backs into resistance. So that's where we are there. And then bigger picture is a weekly chart. Now this looks like this ETF's must have been launched back in here in 2001. So we have not all, but a lot of that bear market that ended there in 2002. And you can see these are my primary uptrend lines. I have two parallel lines running. This one being the most significant. These are the outliers. This was COVID here, and that was that final capitulation kind of puke up in the last bear market. So it's parallel to this one. I often find that when I look at a trend line, when I'm drawing uptrends or channels, and I do see these kind of extra spikes through, quite often it's almost an exact parallel trend line there. So that would come into play too maybe on a meltdown move. And most importantly is we're right above this trend line. We're also flirting with those the key 200-day / 40-week. We're on a weekly chart, so you put them up as a 40 period. It's the same thing as a 200-day moving average on a daily chart. And that's also when you're above them, the trend is bullish, and we are. But not by far. Look, we took them out here recently. We had a red candle close there and a follow-up red candle. We printed a close just above there. So we're in close proximity. Sometimes you slice through them a little bit, but generally the trend has been in a bear market, you're usually below those trend lines. And once you recover, that at least that the trend on this time frame is bullish, and we've recovered them here. And so I'm watching this closely. Like I said, we're so close now. We're a hair above. We were a hair below before, actually quite a bit below a couple weeks ago. But we also hit that uptrend line right there. So I'm watching this, and again, there's that downtrend line you have there. You could draw it on the weekly as well, and you can do that. As a matter of fact, with QQQ, and let's see how we close the week. See, I talk about this a lot. If you are a longer-term trader, investor especially, this is your time frame, the weekly charts. And as I always say, anytime you're trading off a particular time frame, whether it's a 5-minute chart because you're an active day trader, or a weekly chart because you're a long-term trend trader, all that matters is how you close the weekly candles. So we could still close back below this, and all that would be at the end of the week. See these skinny parts here on the candles? These are called shadows. Upper shadow is also known as a wick. The lower shadow they call a tail. So if the week closes with the candle on or below that trend line, you're just going to have a little wick, and that's an intraday pop. So that's something else I'm watching for. And it actually, now if my near-term thing plays out, my near-term call for a pullback to these levels, that is going to be the case. Okay, so there's that. All right, so I covered, let me look at my notepad. I want to make sure I cover everything here. TNX, so there it is. As I showed you earlier, yields are the 10-year, which is most important, is at key support. And although there's divergence is not a sell signal. It's an indication that a trend change is likely. But those divergences could either grow larger if we bounce here, yields bounce. And I'll tell you what, like I said earlier in the video, and like I said a couple weeks ago before we had this rally, that just when it starts to look good. That is the nature of a bear market. I use that quote, or that line from The Usual Suspects. The greatest trick the devil ever played was, I forget exactly what it was, is convincing the world that he didn't exist. And that was referring to Kaiser Soze, the bad guy in the movie. Anyway, that's what a bear market does. It tries to make the masses believe that we're not in a bear market, that it's a bull market, and there's a lot more upside. So, in going off that, so if you're tracking maybe you think it's convoluted logic, you almost have to say, you know what, just when this rally looks good, that's probably when it's going to stop. Just when everybody thinks interest rates have peaked and are not going up anymore, that's where you could get another spike up. And most importantly, even if it's just a upward trend in yields over the next couple weeks, that would be enough to rattle the market, because I know the market is still hypersensitive to rates. So we'll keep an eye on that as well. Okay, and so that's it in a nutshell. Like I said, it's hard to make a super bearish case right now, especially with the NASDAQ being above the trend line. However, let's say we close a week below, then that's going to be a failed breakout. That's going to be bearish. It doesn't mean it's the end of the world. Maybe the NASDAQ just wants to come back down, power, and then work off some of the overbought conditions and then power through. But like I said, there is that potential that that this is it, and we could go on down. And so, like I said, I give you some trading strategies if you want. And the other thing too, on the things to watch, let me just wrap up here. So I still have my watch list that I came up with. It's been, I don't know, 6-8 months now. I started putting together a watch list called TTW. I've covered that with you before. Things to watch list. In it, I'm just clicking on it. It's on another monitor right now, but I have things such as the 10-year treasury yields in there. I have a lot of, auto dealerships and key stocks like that. Carvana and CarMart, America's CarMart. That's CRMT. Excuse me there. CarMax. XRT. Retail. I've got the banks in there, and so I am watching these things very closely. And like I said, recently we had some pretty darn bullish developments on a lot of these things. In the banking sector, we had positive divergences. I'll get to that in a second. Even here in retail, we had about an equal low there. Actually, there's your positive divergence. We had lower lows there, positive divergence. Pop, there could be a little bull flag going on right there. So there is quite a bit to like in the charts right now. Again, I just have to map that bigger picture. If we are in a bear market with a lot more downside to come, this is a signature move of a counter trend bear market rally. It does a great job of convincing, people both from a fundamental perspective, meaning economic indicators and that kind of thing, as well as technical, that get in, buy. And that's usually when those bullish setups, just when they start to look good, and the breakouts have all just recently occurred and the buyers start coming in, that's often when they fail. So only hindsight's going to tell us for sure if that's what this is. But again, I have all these other things here, and I'm just going to click through, not all of them right now, my things to watch list, but that's a big one. FedEx right there, put on a divergent high recently, broke that, both trend lines that I have there, but it's holding above this support level right here. And a lot of things did this. They recently punched through. Remember, again, it was a test. These are the 200-day moving averages right here. So we punched through price support and the 200 days, but recovered. So I'll tell you this too, if you want to play it safe, you just wait for a break of the recent lows, because the 200s have been tested in the markets. On the NASDAQ 100, a lot of those key stocks. And again, I have not changed my tune one bit unless these go. You really want to play it safe. Like I said, taking a short here now that you plan to hold and give wide stops to in anticipation that this nice looking rally is going to get sold into, that is aggressive. The payoff is high. because if you wait for all my purple levels to go, let's say, for example, on Apple has to now drop about 9% just to get down there. So it's going to have to drop better than 10% to give that sell signal on the lower purple line that I have. Microsoft, it's still at 311. That's a big way down. Microsoft would have to fall, over 14%, about 15% to trigger that. Alphabet, let's see if it loads here. Alphabet, about 121. Amazon, have the purple lines. Remember our price level at 123. We punched that briefly, but my lower purple line was the uptrend line. That also came in with the 200-day. So again, this was a great buying opportunity. It's where we went long. Now the $1 million question is that, are all these stocks going to go to new highs from here? And if we're going to have that marginal new high scenario in the stock market, then yeah, these big fangs most likely will. In fact, that's the only way we're going to get the marginal new high scenario in the stock market. But well, I was going to say, it feels like, I don't have to say that, it's not a guess that there's a lot of short covering because I read about it. Recently, you had a lot of, they said a lot of hedge funds were positioned short, some of the highest short ratios and short interest readings in a long time, especially among institutions. So I have no doubt, because it's been written and I could just know where things are, that a lot of shorts were caught off guard. And again, I'm surprised that, they waited until the Fed made it official. And it was maybe also Apple. Remember Apple reporting earnings, but now that that's all out of the way, I guess that's where everybody gobbled up stocks. And this is a lot of short covering, in my opinion. And I'll show you another indicator. I told you I'd show you a few things in here that I haven't showed you in a while. This is QQQ. And let me just find a clean board here. No, I got to go to this one. All right, forget about what's up top. These are old lines carrying over from another board. I don't know why that's happening right now. Let me make sure I'm on a daily time frame. But if you look down here to volume, here's an indicator that I've shared many times in the past. And I have a couple lines, depending on market conditions and where things are at the time. Back here, it used to be these red and yellow lines that triggered these sell signals. And what I call it, something I came up with years ago. I've been using this now for probably a decade or more. It's just a pattern I've noticed in SPY and QQQ and the main indexes. Played around with it for a while and came up with putting a 10-day exponential moving average on the volume, because that smooths out the little spikes. You don't ever want to take too much from one single day volume. You might be able to identify a buying or a selling climax, but sometimes you have these big days and sometimes low days. So by 10-day exponential moving average, it's kind of showing you the trend. And so while not a perfect indicator, because we had a little, drop close to that level right here, it didn't fire. Quite often when you hit this level here, you can see these last few hits. And most importantly, this purple line is my level now and has been throughout this bear market. This was the top in the NASDAQ right here, right? It peaked. We had pretty much a double top November and then the beginning of the year, and that's when the S&P 500 and every other index stopped right there in the beginning of 2022. And you can see my low volume sell signal triggered. That's when the 10 period exponential moving average on the volume hits that line. It's whatever it's at, about 45 million shares. Hit it again here, and you can see the timing. You can see what happened after each of these tags right there. You had one right there. Ignore it once you've had the signal, you got to wait for a while for it to reset. So this one was and is a false, that you didn't get it there. In fact, things went the other way. We exploded to the upside. So again, there's no one indicator that's 100% effective. If there was, I would not be talking to you. I'd be using it and doing my best to keep that a secret. All you can do is have different indicators. And then I always say this, don't continue to always use that indicator. Pay attention and see which market conditions it works well in, and then learn to recognize when it stops working. But so far, it's done pretty darn good. You can see it here. got in, market went just a hair higher, then had a nice correction. We hit it here recently, right about here actually, and we got all that, and we're volume's plummeting. So what this also tells me, and why does this work? Is it random? Is it just some crazy thing? No, because when stocks are going up and all of a sudden volume starts drying up, it shows you it's running on fumes. That rally is running out of buyers, and shorts have given up, and then boom, and then the turn comes. And so I just wanted to point that out. This is another reason why I think this rally, like I said before it even happened, just when it really starts to look convincing to the masses, that may be when it ends. So that's it, guys. And again, I started the video with 2 strategies. If you disagree with me, what I always say is, where I believe, I bring value is identifying key support and resistance levels. So you might not agree with, my longer term outlook or even my near term outlook, which again, at least those 3 pullback targets, that pullback target zone. But if you don't, then again, what I'm identifying are support levels that are likely to produce a reaction, starting with the back test of the trend line, then 366.77, then 354.50, and then 361.60, and that uptrend line, which should come in together if and when we get there. So the takeaway is a bull can use these levels to add to long positions or get in case you miss the rally, whereas a bear, someone looking, for more downside, can wait until those levels break as the next sell signal to add to short positions. Or, of course, same thing in reverse. Support once broken then becomes resistance. So let's say we do fail the trend line and we go back there and we hit that, and you didn't want to short here today, but you really feel like shorting here after the market's dropped 3% plus. Might not be objective because you'll probably bounce off the first test of that level, but then you can use the primary downtrend line or any of these former, if at the time, they would be former support, now resistance levels to add to short positions. Okay. Well, I'm going to wrap up, but I wanted to add, there was an analogy I wanted to use for the market and just kind of share my thoughts, more of a fundamental perspective, if you will, and that is, a stress test. I think the market just went through one heck of a stress test with interest rates breaking out to new multi-year highs, and we saw all the things I was looking at, including and not limited to the big banks, banking sector, the regional. We saw a lot of big banks coming under pressure. Of course, they bounced. Technically, they hit support, and that's XLF. This is the financial sector ETF. But a lot of those things that I have in the things to watch list, Visa, MasterCard, the banks, the non-bank financials, they were in the regionals really stress tested. And so, if you've ever been to done a stress test, a cardiologist recommends you get on a treadmill. They have you go till you can't go anymore. You're pushing your heart to its limit. They're monitoring that. So here's the analogy I want to look at. So from a fundamental perspective right now, I can say, man, you can make a pretty good bearish case that we were at the red line. Remember just a couple weeks ago when we were at lows, it was the biggest correction we've had in many months. And I said, we were the market was running at the red line on the tachometer, like on a car. And you keep running the engine at the red line, that engine is eventually going to blow if you don't back off. So we ran it to the red line, just like the market did a stress test with those high rates. Nothing broke. We didn't have any bank failures or any big, surprises yet. And now interest rates have come back down. So the tachometer is no longer on the red line. And so from as of now, that's good. That's bullish. And if rates continue to fall, well, again, the case can be made for a multi-month rally into year end, maybe even into 2024, if there's no problems. The only thing I want to leave you with is that a couple nights went out to dinner with some friends and family, and someone was talking about Matthew Perry, which I'm sure y'all heard just passed away recently, Chandler from Friends, and again, I don't really follow this stuff. I don't follow People Magazine or whatever the news is. I heard he died, but he was saying that that they did a thorough check and they didn't find any alcohol or drugs anywhere in the house or around him. And the story was that he had just worked out at the gym, came home, got in the hot tub or whatever, and then they think that, because he'd already had a weakened heart from all those years of drug abuse, that getting in the hot tub dilated blood vessels and from the post-workout exhaustion, that's where his heart gave way and he had a heart attack. And it makes me think of the stock market. We just got stress tested. And I've heard stories before of other people. I've heard stories of people going to the gym, working out. Sometimes, you'll see it. An athlete will die on the field of a heart attack. It's rare, but it happens. Or someone in the gym working out. But I've also heard quite a few stories of people work out, come home on the way home, drive home, or after they get home, then the heart attack happens. So keep in mind that, yes, the market's been stress tested. Nothing broke at those super high rates, but that doesn't mean it's not going to. Everything that got stress tested really hard and pushed down, the regional banks, all the FedEx and Amex and Visa and, all those things that I've been looking at as which are pretty indicative of what's going on in the economy, like FedEx, UPS, Visa, MasterCard are probably two of the biggest. The banks, of course, again, they rallied pretty hard off the lows. A lot of them put in divergence, held support. But I just wanted to point out that the lag effect from these high rates is still very, very much a risk right now. Just because we hit the red line and nothing exploded or blew up, the engine didn't blow then, doesn't mean that it can't going forward. So I'm going to continue to watch all those things. I've covered them in the past. And I've talked about this recently. I kind of have a map where things are going. I'll either be right or wrong. That map it may change over time, but my map, mental map, if you will, the way I see this market going, is I still believe that this is a bear market rally that we've been in since October of last year, so about a year now. I think I still maintain that most likely my preferred scenario is that was the end of the bear market rally, and this was the beginning of the next leg down, and that at some point soon that will accelerate. When does that? And if that's my map and my primary preferred trading or preferred outlook for the market, then what I need to do is look to short rallies into resistance. Like I said, I'm a little bit cautious right now because of the pullback in rates, and that is, like I said, I can make a pretty damn bullish case, both technically with everything bouncing off the 200 days and key support. So it's not that all-in aggressive short moment yet. But again, I think a case can be made to put back on some swing shorts. And there it is, stops right above here. If we take out, there's a whole confluence of resistance overhead. And if we take that out, that cannot be construed as anything but bullish until and unless that breakout fails, okay? And if it does, then that's it. So if you get stopped out and then all of a sudden the thing turns around, that was a big stop clearing move, big fake out move, and I'm talking about popping all these support and resistance levels overhead. You got a big old gap right there, just a confluence of support. So that's it. There's the level somewhere in here, tighter, looser, it's up to you. A stop for a longer term swing position, a short position, or if you're bullish, wait for a breakout. To go long right now, just below a lot of resistance is just, it goes against, conventional wisdom in trading. You want to wait if you're rallying into resistance, at least wait for a breakout above that resistance. And ideally, on a pullback right now to work off the near-term overbought conditions. When I say near-term, that means you go to the shorter-term charts, like a 60-minute chart. And you can see here on the 60-minute chart of VTI, that's the most overbought we've been since this point right here. And you can see what happened if you, I was just a little off a little bit. You can see what happened if you would have bought that at that time. So, all right, guys, I'm going to wrap the video up here. This has been Randy Finney with Right Side of the Chart. Have a great day.